Hello and welcome to another presentation on IND AS. So today we are presenting IND AS-7 statement of cash flows. So let's quickly have a look at the agenda that we're going to cover as a part of this IND AS. So we're going to touch base on the objective of the IND AS, the scope, uh, the cash and the cash equivalent. We'll understand what exactly these means, components of the cash flow statements, we'll have an understanding of operating activity, investing activity, and financing activity. And then we'll see that how the reporting is done for the cash flow. We'll also look at the impact of foreign currency on the foreign currency cash flows, interest and dividend, taxes on income, investment in subsidiaries, associates and joint ventures, and non-cash transaction. We'll quickly have a look at how the treatment of bank overdraft is being done while defining the definition of cash and the cash equivalents, and then the disclosure, and then finally we'll have a quick synopsis in terms of how IND AS is different from international accounting standards. So with this, we'll start our discussion. Okay, so let's just quickly have a look at the objective of this IND AS. So IND AS-7, which is on the cash flow statements, provide user of the financial statement with the basis to assess the ability of the entity to generate the cash and the cash equivalent. So typically, the objective of this accounting standards is to disclose that how organization or entity is generating the cash from the operations, from the financing, and from the investing activities, and then how these cash is getting utilized in day-to-day business operation, and how it is being spent towards the financing activity in the form of the interest that is being paid, or how it is being expended in the form of the investment activity while we are purchasing or creating an asset for the organization. It also assesses the ability of an entity to generate cash and cash equivalent, and the timing and the certainty of their generation help users to assess the liquidity and the solvency. So typically, if we look at the broader objective is to evaluate whether the entity is sound enough to manage its liquidity position, the solvency ratios. Because if you recall, in AS1, when we were talking about the presentation of the financial statements, and we were discussing about the accrual concept. I think only thing that is not being based on the accrual is the cash, wherein it has to be done basis the inflow and the outflow of the cash. And the objective here is to ensure that the cash in hand with the organization is there, and they have enough liquidity to manage their day-to-day operations. Plus, they have long-term visibility on the financial position in terms of the liquidity, and they have liquidity to ensure that they can also manage their long-term commitments. The objective of the standard is to require the provision of the information about the historical changes in the cash and equivalent. And when we try to come up with the comparative analysis with IND AS-7, so this IND AS-7, which is IND AS-7 is largely in line with the IAS-7, which is International Accounting Standard. So there is no gap. So we'll quickly move to the next slide and look at the scope of the IND AS-7. Okay. So let us quickly spend some time in understanding the scope of IND AS-7. So scope is an entity shall prepare the financial statement in accordance with the requirement of standard. So which means that this is an integral part of the presentation of the financial statements. So when we were looking at the IND AS-1, that was typically into the presentation of financial statement, in which cash flow statement was also one of the element as per the Schedule 3 of the Companies Act, wherein we basically entities required to ensure that they prepare the cash flow statements. User of an entity's financial statement interested in how the entity generates and uses the cash and cash equivalent. And entities need cash in essentially to same reason, however different their principal revenue producing activities may be. They need the cash to ensure they need the cash for essentially the same reason, however different their principal revenue producing activity might be. They need cash to conduct their operations, to pay their obligation, and to provide return to the investors in the form of the dividend. According to the standard, requires all the entities to present the statement of the cash flow, even the bank entities. So basically, there is no kind of leeway to anyone. In fact, in any industry, even banking and financing industry needs to present their, financial statements, and they have to include this cash flow statement as a part of their financial statement. So objective is to make sure that it should represent, the scope is that it has to be cover all the movement of the cash starting from the beginning of the financial year. They have to ensure that whatever movements which are done in the cash in forms of various activities, this is operating, financing, and investing activity, and what is the closing balance of the cash and cash equivalent. And there are certain disclosure requirement that they need to show, which we are going to discuss during the presentation, and we are going to focus on each of those specific disclosure that are required to be done specifically to the items that we mentioned in the agenda, which includes how we have to disclose the translation of the foreign exchange, how we have to disclose the cash transactions when we are dealing with the subsidiaries or joint ventures or associate, how we have to deal with the transactions when we are dealing with bank overdraft. So all those things which we're going to discuss in detail in the coming slide. But scope is that it has to cover all the transactions. Financial statements should represent the cash flow statement as an integral part of their financials, and cash flow statements should depict the opening balance, movement during the year, and then the closing balance. And if we talk about the differences or the similarity between the international accounting standard, so scope is same as far as international accounting standard is concerned. So let's just quickly move to the next slide and see some of the key definitions then. Okay, so let's just spend some time in understanding the key definitions. So when I talking about key definition, the most important definition is the cash and the cash equivalents. So what does cash mean? So cash comprises of the cash on hand and the demand deposits. Means the deposits which can be easily be encashable at any point in time and on the demand. So largely the balance in our current account is constituted to be equal to the demand deposit. So cash includes the cash component and demand deposit. Now it has another element which is the cash equivalent. What does this mean? So cash equivalents are short-term, highly liquid investment that are readily convertible to known amount of the cash and which are subject to an insignificant risk of changes in the value. Very, very crucial point to discuss here. So which means that cash equivalent, anything can be treated as a cash equivalent if first it has very low maturity period, and second, upon the conversion the value realizable should largely be the same. It should not get fluctuated. For example, if we have invest some amount in the equity, right, and we say that it is only for 2 months, and after that 2 months we are going to get an amount which is different from the amount which was investment, it will not be considered as a cash equivalent, because to to confirm the cash equivalent, it has to satisfy both the principle. It has to have the lower maturity period, plus the value realization should largely be the same in which it was being deposited. So what are then cash equivalents? So let's just quickly do a deep dive and see what are the cash equivalents. So cash equivalents help for the purpose of meeting the short-term cash commitment rather than for investment in other purpose. So treasury bill with 60 days maturity, overnight money market deposit, 1 month commercial papers, which are like known that this is the amount which you are going to get after a particular period of time, low maturity period, and can easily be encashable. For an investment to qualify in cash equivalent, it must be readily convertible to known amount of the cash and be subject to an insignificant risk or change in the value. Absolutely yes. The risk associated to that short-term investment should be absolutely insignificant. And we have invested with an intent that it's going to convert it into the cash in very short period of time. Therefore, an investment normally qualifies in cash equivalent only when it has short maturity of say 3 months or less. 3 month period has been defined by the standard, or from the date of the acquisition. Bank borrowings are generally considered to be financing activities because it is being borrowed for a certain period of time. However, where bank overdraft, another critical point which is being brought here is that, however, where the bank overdraft which are repayable on demand from the internal part of the entity's cash management, bank overdraft are included as a component of cash. So which means that if we are using the cash bank overdraft facility as an integral part, as a day-to-day operations part of my day-to-day expenditures and other things, then definitely bank overdraft can be taken as a part of my cash equivalent. Equity investment are included from the cash equivalent unless these are specifically for cash flow. For example, in case of the person preference, so only for preference share wherein we know that there is a specific period and shorter period of their maturity, and we know that the right amount that we are going to get are something which we can include it as a part of the cash equivalent. So again, the major understanding and the major logic to construe anything as a cash equivalent are two. First, it has the very insignificant risk associated to it when we are doing some investment, and secondly, it is readily convertible to known amount of the cash, and it largely the period of 3 months is being taken as a something which is being defined in the standard. Therefore, investment only normally equals a cash equivalent only when it has shorter maturity period, say 3 months or less from the date of the acquisition. So this is the definition of the cash and the cash equivalent. Now let's quickly look at some of the example of the cash equivalent to have some better understanding on the same. Okay, so let's just quickly have a look at some of the examples. So instrument equity share cash equivalent, no reason high price volatility. Okay, equity mutual funds, no, again valuation risk. ETF, no, against not fixed value. Liquid mutual fund, not automatically must satisfy 3 month or the lower risk criteria. Redeemable preference share possible if maturity period is less than 3 months. Fixed redemption. Treasury bill, yes. Short term lower risk. Commercial paper, yes. Short term lower risk. So cash equivalent must meet all the following: short term maturity, typically 3 months from the less from the date of the acquisition, highly liquid, easily convertible to a known amount of the cash, and insignificant risk. So which means that any instrument, if it qualifies these criteria, then definitely it can be treated as the cash equivalent. But if not, then they cannot be treated as the cash equivalent while presenting the cash flow statements. So let's move to the next slide then. So component of cash flow statement. So what are the components of the cash flow statement? Uh, Cash flow statements should definitely show the cash flow from the operating activity. We are going to speak about it in the coming slide. Cash flow from the investing activity, we are going to speak about it again, and cash flow from the financing activity. Apart from that it should show the net increase or decrease in the cash and the cash equivalent and the final cash equivalent reconciliation. So this is the prescribed format of cash flow statements, which has to depict all these information: operating, financing, investing activity, and then net increase or decrease in the cash and the cash equivalent, and then the reconciliation, which means that this was the opening balance, this is the movement, this is why closing. And then it should tie back with the financials as well. So we'll move to the next slide then. Okay, now we'll spend some time in understanding what are the operating, investing, and financing activities. So we'll start with the operating activity. So operating activities are the primary activities which are the normal operation of the business. So which means that normal activities or activities that result from the transaction and the other when that enter into determination of profit and loss account. The key activity or revenue generating activity of the business or enterprise is defined as the operating activity. For example, if somebody is in the trading business and they are trading in trading businesses largely in the trading of the goods, so that trading of the goods is largely constituted as the operating activity. If somebody is in the business of construction contract and they are building the infrastructure, so that infrastructure itself in that case will be treated as the main operating activity. Likewise, for banking and financial institutions, the normal lending, and then they can also receive the deposit. All these are treated as their normal operating activity, and hence that has to be construed accordingly. So, operating activity is the key business activity which is being performed by the entity to generate this revenue. So if you look at the activities here, the cash received from the sale of the goods and the rendering of the services, cash received from the royalty, fees, commission, and the other revenue, and cash payment to the supplier. So these are like my normal inflow and the outflow on account of the business activities that are being done to manage my business. So these are largely these are the activities which are largely classified as the operating activity. So there are some transaction during the course of the business wherein we are either disposing of some of the assets that we have purchased and then we are incurring some profit or loss on that. However, the profit and loss of that is being adjusted or recognized in my profit and loss statement, but the cash flow on account of those sale is largely being shown under the investment activity because that is not the principal activity of the organization. And similarly, if let's say an entity may hold securities and loan for dealing in the trading purposes. So if entity's main business is to purchase and sell the security, which is like trading of the securities itself, then it will be construed as the operating activity for that segment. But let's say if an entity whose main business is largely on account of trading of the goods or largely in providing some consultancy services, then in that case, any kind of the activity which is being done to show as the purchase of the security or the sale of the security is largely constituted as the investing activity. and we'll have to look at the nature of the business to determine the operating activity, because operating activity depend upon the nature of the business of the organization. So we'll quickly move to the next slide and see definition about the financing and the investing activity. Okay, now we'll quickly have a look at the investing activity. So, investing activity means any activity that resulted in the acquisition of asset in my balance sheet. So, if you look at this one, only expenditure that result in a recognized asset in the balance sheet are eligible for classification as the investing activity. So, which means that any expenses or any outflow of the cash which result in the acquisition of the asset, that will be classified as an outflow on account of investing activity. Likewise, any sale of the asset will be considered as the inflow on account of the investing activity. So all the activities, all the movement in the cash flow which has resulted in the creation of an asset within the balance sheet, that will be classified as the investing activity, and their related disposals will be treated as the inflow on account of the investing. Now, one more thing, when a contract is accounted for a hedge of an identified position on the cash flow of the contract, is classified in the same manner as the cash flow as the position of the original transaction. So, which means that if we have taken any forward contract or the future contract, the change or the outflow or the inflow on account of that hedge transaction will be classified depending upon the underlying position that has been taken. For example, if the underlying position was taken on the inventory, then definitely it will be classified as then operating activity. But if underlying position has been taken on account of some loans or some investments, then it will be classified as financing activity or the investing activity, as the case may be. So typical example, if let's say I've taken a forward contract for the inventory, okay, that will be classified as my operating activity if any outflow or inflow happen due to that. And then definitely if it is my financing activity on account of some loans, then it will be classified as the financing. So we'll move to the next slide then. Okay, so likewise, we need to disclose the cash flow on account of the financing activities. So typically, financing activities are these activities which are being incurred to finance the business. So which means that if we have taken any loans from the banks, or we have issued some debenture, or we have raised some capital through the equity shares, or let's say we have paid some dividend. So any kind of those transaction that is impacting or that is required to finance the business, that is largely classified as the financing activity. Cash processed from issue of the shares, cash payments or to the owners to acquire the entity shares, cash proceeds from issuing the debenture or loans, cash repayment of the amount borrowed, cash payment by the lease of the reduction outstanding liability related to the finance lease. So any amount that is being inflow or outflow on account of financing the business operations is largely taken as the financing activity. So with this, we are clear in terms of what are the operating activity, what are the financing activity, and what are the investing in activities, because the understanding of these three terms are critical while we are preparing the cash flow statements. So we'll move to the next slide then. Okay. So let's just quickly cover on the reporting aspect of it. Cash reporting cash flow from the operating activity. So if we look at the language of the standard, the standard does not prescribe any method in which we have to report our cash flow statement. So both direct as well as indirect method are there, but preference of the standard and recommendation largely is for the direct method, because it is very transparent. It show the clear inflow and the outflow of the cash. But the reality is that still most of the companies are doing the indirect method of cash reporting, whereby they started with the profit and loss account, and then they adjust all the accruals, the movement within the current liabilities, current assets, and then finally show the total inflow and the outflow of their operating. The reporting of the cash from the investing and financing activity, entity shall report separately measure all classes of the gross cash receipt and the gross cash payment arising from the investing and financing activity, except to the extent that cash flow are permitted to be reported on the net basis. Reporting cash flow on the net basis is largely allowed, which is as prescribed by the standard. For example, cash receipts and the payments on behalf of the customer when cash flow reflects the activity of the customer rather than those of the entity, which largely reply to the banking industries, wherein they can, or investment company, wherein they are showing that this is the amount which is the amount recoverable from the client, and this is the amount which is the amount which is payable to the client. They show it on net basis because they are not reporting for the entity, they are reporting for the client. Similarly, cash is in a payment on terms of the which turnover is quick. So principal amount and credit card customers are typical example when they are showing the multiple transaction of the credit card. Instead of showing each transactions or the details separately, they have to show the total amount on the net basis. So apart from that, see again, if you look at the way accounting standard has been constructed, and not for this standard, for all the standards, the main underlying premise is a transparency. It has to be transparent, and the disclosure should be to such an extent that will enable the investor to take the decisions and take the actions on that. So likewise, that if at all if any information is required to be or reported on the gross basis, it has to be done on the gross basis. Standard does not prescribe any method, but it specifically call about the conditions under which they can be reported on the net basis, which we have here. So we'll quickly move to the next slide then. Okay, so one more example of net basis is that cash flow arising from each of the following activity for financial institution may be reported on the net basis. So again, cash receipts and the payment of acceptance on deposit for fixed maturity rate, the placement of the deposit with and withdrawal of deposit from other financial institution, and the cash advances and loan from the customer. So typically, again, the only exclusions or only the exceptions to be shown on net basis has been prescribed by the accounting standard, and we have to follow the same prescription while reporting the investing and the financing activity with the net numbers. Now we'll quickly talk about the foreign exchange cash flows. So foreign cash flows arising from the transaction in the foreign currency shall be recorded as an entity's functional currency by applying the exchange rate between the functional currency and the foreign currency at the date of the cash flow. So which means that any transaction that has been entered into a foreign currency, that needs to be translated into the currency in which entity is reporting their numbers at the rate at which the transaction has happened. Okay, so which means that if we have taken any loan and we have to report that number as the loan which is there in my books of accounts as a particular currency, multiply by the translation rate in the Indian currency, assuming that I am maintaining my financial record in INR, and then I have to show that amount as the inflow from the loan, and it will be shown as in my financing activity. Now, it may happen that during towards the end of the year, there is some translation impact, which means that I end up paying some extra amount because of the exchange rate has increased, which means that there is a exchange rate outflow, which will be shown separately as a reconciling item or separately as a separate item in the cash flow statement and will not be merged in the original financing, investing, or the operating activity. So we'll quickly show this as a uniform example in the next slide. But any unrealized gain or any fluctuations which is there, that will be recognized in my profit and loss and will not impact my cash flow statement. The cash flow statement will be impacted only when the settlement happens toward the end or any activity which resulted into the outflow or the inflow of the cash. And at that point in time, any rate fluctuation will be recorded or shown separately in my cash flow statement. So we'll just quickly have a look at the example then. Okay, so here's a quick example here. Company ABC Limited reporting currency INR. Company holds USD cash in its bank account. Okay, they have some balance in their USD in the bank account. Step 1, opening cash and cash equivalent is INR 3 lakh rupees. USD balance USD is 5,000, which is the rate of 80, which is like 4 lakh rupees. So total cash and cash equivalent is 7 lakh. Closing cash and cash equivalent is INR is 5 lakh rupees. USD balance is 5,000 into 85, which has been increased in the rate. It is 4 lakh 25,000 and total is 925,000. So how it will be reflected? Opening cash and cash equivalent is 7 lakh. We have increase in the cash and cash equivalent, let's say from 3 lakh to 2 lakh, 5 lakh, which is like 2 lakh. So assuming that these are operating activity only. So net cash from operating activity is 2 lakh. Subtotal, which is before the foreign exchange translation, is 9 lakh. And then we have to separately show the effect of exchange rate, which is 25,000, and our closing balance is 9 lakh 25,000. So FX gain or loss should be shown separately so that we can clearly articulate the impact of such increase or decrease in the overall closing cash and cash equivalent. So with this, we'll move to the next slide. Okay. So we'll quickly look at the treatment of the interest and dividend. So simple thumb rule: any kind of interest and dividend which is received and paid shall be disclosed as operating activity if that is being done by investing company, if that is being done by the financial institution rather. Apart from that, any interest received, any dividend received will be classified as investing activity. Any interest paid, any dividend paid will be treated as the part of my financing activity. uh, any amount which has been accrued in my financials because of borrowings that have been taken as per the AS-23 will be classified as the item of the expense in my P&L. But the impact of the outflow in form of the cash will only be shown when we are either paying some interest on that or we are paying some installment which includes the portion of the interest. So both in that case both will be shown as my financing. So we'll move to the next slide then. Okay. The treatment of taxes on income in the cash flow statement. So, see, typically we normally pay tax because we are doing the operations, and any kind of the payment of taxes would largely be classified as an operating activity, unless and until a transaction is that it is closely associated to either of my financing or the investing activity. Then, in which case, it has to be shown for the investing or financing activity. So, what that is says that taxes on income arising on transactions that give rise to cash flow that are classified as operating, investing, or financing activity in the statement of cash flow. Well, the tax expense may be readily identified with the investment or financing activity. The related tax and cash flow are often impractical to identify, and they may arise in the different period from the cash flow from the underlying transaction. So, see, the thing is that we are paying so taxes are getting accrued and being shown as an expense in my P&L, right? And that can arise for multiple reasons. Largely 90 to 95% is on account of my operating activity. But if at all there is some activity which resulted into the tax implication, and for that activity we cannot show it separately because we are paying the taxes as a total tax to the government. And if it is impractical to show the bifurcation of the investing and financing activity, then simply you can show it as an operating activity as a thumb rule. But in case it is easily identifiable as a part of my investing activity, then it has to be shown as the specifically for that activity. For example, capital gain tax on the sale of the land can be shown as an investing activity because it can be easily identified and specifically shown that this is a tax that is based on the capital gain. And capital gain normally arises when we are disposing of long-term assets. So it can then be shown as the capital gain on the sale of the land, and the tax outflow will be shown under the investing. So we'll move to the next slide then. Okay. So investment in subsidiaries, associates, and joint venture. So for better understanding what we have done, we have created a small table to showcase that how each item would be shown, and then also we have showing the how the treatment is happening in the equivalent IND AS. So if we buy a subsidiary, it is an investing activity in the consolidated financial statement. It is investing in the standalone. IFRS also the same. If we are selling the subsidiary, inflow on account of investing, same, no changes. Dividend received from subsidiaries are largely eliminated in the CFS, but it is shown in investing in the financing activity in the standalone statement. And in IFRS, it is shown as a choice. So which means choice. What is the choice then? Choice is between the in either as an investing activity or the operating activity. That choice is being shown here: investing activity or the operating activity if we are dividend from the subsidiaries. Dividend from the associate is in investing activity. IFRS still shows that there's a choice. You can still show as an operating activity, but for IND AS-7 it is strictly saying that it has to be investing only. Share of the profit in associate is normally an operating adjustment because it is just an book adjustment and it is not resulting into any cash inflow or the outflow. Loans given or received, investing activity, same. Interest received is again for the CFS it is eliminated, but it is shown as investing activity. Again, IFRS allows the choice of showing as investing activity or the operating activity. Net cash or acquisition or disposal is net investing in the same. So what exactly it means that apart from these minor differences, wherein the dividend received from the subsidiary or the associates and the interest received from the associates or subsidiaries are classified as separate investing activity as far as IND AS-7 is concerned, but uh, IFRS or IAS 7 gives a kind of a levy to it, whereby it shows it says that it gives a flexibility wherein it can still be shown as an operating. These are the minor differences, but apart from this, it is like IND AS 7 is equal to IAS 7. So we'll move to the next slide then. Okay, so non-cash transaction. So there are many transactions within the financing and the investing activity that actually result in the transaction but did not result into the movement of the cash. In which case that they are not shown in the cash flow statements. They are reported as per the specific requirement which is applicable to that particular transaction as prescribed by the any other standard in the entire IND AS series. So we'll just quickly have a look at those transactions then. So what are those transactions? Example of non-cash transactions are issue of the shares to acquire an asset, conversion of the debt to equity, unrealized FX adjustment, fair value adjustment, depreciation and amortization, acquisition of the assets either by assuming directly or relating to the liabilities. So which means that these transactions do not result in the cash and hence they are not being reported into the cash flow. So if we have a look at the bank overdraft, so I think we already covered this as a part of the cash and cash equivalent. So wherever the bank overdraft form the integral part of the cash management, then it has to be classified as the cash and cash equivalent. And if it is not the integral part, then it has to be classified as the financing activity. We'll move to the next slide then. Okay, so we'll come to largely the last slide, and then we have one more slide on the showing the differences between the IND AS and the International Accounting Standard. So disclosures, what are disclosures? Some disclosures that we have to show here. An entity shall disclose the component of cash and cash equivalent and shall present the reconciliation of the amount in the statement of the cash flow with the equivalent item reported in the balance sheet. An entity shall disclose together with the commentary by the management the amount of the significant cash and the cash equivalent balances held by the entity that are not available for the use. So there are certain cases wherein they are holding the cash, but they are not. They cannot use that cash in the normal course of operation, and then that has to be disclosed. This is largely in the cases wherein there are some restrictions when the company is reporting the consolidated financial number and they are reporting the number for their subsidiaries as well, but few of the amount that can specifically used by that subsidiary only in a particular case, and they cannot be freely available for the holding company. So these are like certain specific and exclusions for that, but otherwise everything has to be reported as per the requirement in this particular standard. So disclosure requirement are largely these five. So reconciliation of the cash and cash equivalent, significant non-cash investing financing activity, accounting policy choices, a component of the cash and the cash equivalent, and restriction on the cash balances. So will this will come to the last slide that will quickly show the differences between the IND AS-7 and the International Accounting Standard. Okay, so this is the last slide for the key differences. So I think we have already covered, largely we have covered because each slide specifically talk about the comparability with the equivalent IND AS, and we specifically show at the top on each slide, which is whether with this is compliant with the IND AS, IAS or not. And largely everything is being compliant with the IAS, except the one thing wherein dividend paid is being classified as mandatory financing, but it is a choice in the IAS wherein it gives the choice between the financing or the operating activity. So with this, we come to the end. We'll just quickly move to the thank you slide then. Okay, so this is the last slide. So I would like to thank all my viewers and subscribers for watching this presentation till end. It is my sincere request to please cascade to all the users and people who want to understand the Indias, who want to understand and refresh their knowledge. It can also be consumed by students who want to refresh their understanding on the Indias for their examination purposes. Please subscribe our channel, like this video, share this video, and do let us know for any improvement that we can do in the form of the feedback in the comment section. So until then, thank you and goodbye.